Today we're going over how businesses are organized. That's as simple as I can put it. So we have a lot of key terms to go along with this, but almost all of these are either self-explanatory or we're going to go over in the lecture. All right, so go ahead and start writing your notes, please. Okay, so this is mainly just trying to understand a lot of the key terms that are here. So your definition for sole proprietorship is very simply, an individual that owns and runs a business. The key thing here, though, is also understanding is that when you do that, you are solely responsible, meaning you are the only one responsible for that business. So if anything goes wrong, if the business closes owing money, you are the one that owes money for that. So you accept all liability, but also the flip side of that is that you get to keep all the profits and determine how you disperse those profits among your business. So then the next step with that is that, well, you can take on partners. So that can be you and one or more other people. And you decide that you all are, as a group, are running that business. So what this also means is that you and all of your partners assume not just the profits, but all the liability. So it requires trust in your partners. So where a lot of these go wrong, where a lot of partnerships goes wrong, is that somebody decides that they want to have more profit over somebody else. So they might do, let's start in the negative. They might do something shady and illegal and cause that business to shut down. Then not only is that individual, but everybody else involved liable for the for the loss of assets, for the loss of money, for any debt that is incurred. So it's if you do get into a partnership or anything like that, is that you have to trust one another, that everybody's going to do the right thing. And then it's a positive and it can be a negative depending on how you look at business. But if you are successful, the profits are shared among the partners. So now there are partnerships that have agreements where somebody gets like 60% of the profits, the other person gets 40, but usually that's based on how much effort somebody puts in. But still, you don't get 100% because you have to split those profits among your partners. So if you're wanting to get 100% of the profits, a partnership may not be for you, and a sole proprietorship is what you want. But if you want to ease the burden on yourself, partnerships are very good for that. Then, lastly, what we have, the last type of organization we're going to talk about today is corporations, which is they operate as a separate entity. And we're going to talk about how we create those starting on the next slide. But the benefit of a corporation is that when you incorporate, the responsibility or the liability gets passed on to pretty much no one. And that the corporation in itself becomes like the individual owner. So therefore if you're the owner or creator of a business, and you get to that point of where you incorporate, then you are no longer liable for any debt incurred by that corporation. It's because the corporation is seen as a separate entity. All right, this is going to get a little more complicated, so make sure you get the notes down and continue to write as I begin to explain. Okay, so when you incorporate a business, the first thing is that you have to raise money. And in this case is that there's different ways of raising money. When you either have a partnership or you're a sole proprietor of a business, you can invite investors in. This is what's called raising capital. You can use that money to expand your business. You can use that money to hire more workers. You can use that money for advertising to bring in new customers, so on and so forth. But as a corporation, you can bring in investors, but you're talking about something that is so large that hundreds, like $100,000 isn't going to do that much. You're looking for big, big money. So the way that corporations work is that they are publicly traded companies, meaning that they make stock in their company available. So most owners, like if you start from the ground up and you build a company that becomes a corporation, typically most owners will sell 49% of their stock in their company so that they keep 51%. That gives them control. So they essentially, because they already own the company, they can hold on to 51 shares of the company. And then 49% goes out to be sold. Then people buy up those stocks, and typically we give you the example of one stock is one part of a company. in actuality, it can be, depending on the value of the company, one stock might be worth like 0.1% of a company. So you have to buy a substantial amount of stock in order to A, get a financial return on it, or B, to have any control in the company. So if you own enough of the stock, stockholders actually can earn money annually on having that stock. So at the end of a year, when everything's totaled up and the profits are calculated for that corporation, the profits are distributed after operation costs and so on and so forth as dividends to the stockholders. So they might pocket some extra money based on their investment. You also have what's become a more modern trend too, is startup companies that are that incorporate fairly early and are building towards being a publicly owned company, will offer stock options to employees, either as bonuses or instead of offering them retirement benefits, they'll go, we're going to give you stock in this company. And that's because of the dividend portion. And also because it also creates employee investment in a company, as well as that the better a company does, then the more they're going to get back on those dividends, the more their stock price is going to go up. And when they decide that they're ready to leave, they can sell off their stock and become hopefully instantly wealthy. But that's how they raise money, is specifically by selling stock in a company. It generates funds for it so that it can sustain. So if they hit tough times and they need more money to pay workers, they need more money to continue an expansion, that company will sell more stock in the company, meaning like the owners have to give up more and more stock. And we'll get to how that power play works on the next slide. I'll go over this last point quickly, which is operating, in that corporations are limited by state and federal law. So, and in this case, if we look at the map, which gives us corporate tax rates, so corporations have a lot to look into. So you might have a corporation or a business that starts up in one state, and then when they actually incorporate, they decide to move their headquarters to another state. So part of this is because of tax rates, is that if they have to pay a large percentage of their profits to a particular state, they may not want to reside in that state anymore. So they might move to a state that has a low tax rate or has no corporate tax rate. Then, and then of course the other reason would be that there are specific laws on how to operate and how to function. So if that corporation doesn't want to be bothered with having to be heavily regulated by a state government, then they might move to a state that has almost no regulations or has very few for the industry that they're in. So, but there are limitations to what corporations can do. They just cannot operate fully. Remember, the United States is a mixed economy, so we do have free enterprise and an open market, but at the same time there are government regulations making sure that businesses operate properly for the public. Last slide. In corporations, the people who actually run it are directors. So you've heard this called a board of directors, or they might just call it the board. But these are people who are elected by the stockholders to run the company. So real quickly, just to backtrack. So stockholders in this case are the ones that, so they might elect themselves. So a lot of times stockholders elect the people within who own the most shares in the company. They will either elect themselves or elect each other to the board. So if an owner still has like 51% of the company in shares, then they can be the chairman of the board. They can be the head of the table. If they have to give up more than that 51%, then the next person who has who has the largest amount of stocks could appoint themselves, or the rest of the stockholders would elect them to that position because they have the most money invested in that company doing well. So therefore they should be the one to at least, thumbs up, thumbs down, agree, disagree with some of the decisions being made by the company. So while they're in charge of the overall corporation and making sure that it runs properly. So they go in and they hire executives. They hire the CEO, the COO, the CFO. These people to do the top tier management and execution of the company. Then those executive officers will then appoint managers, and then those managers oversee the everyday workers. It's a nice little tiered system that is very boring and has existed for a long time. But that's the key. So they don't actually get the board of directors doesn't get their hands dirty. They hire other people to do that. But when you have in some cases hundreds of millions of dollars invested in a company, no one's going to expect you to work on the factory floor. So the other important part about corporations is that they and about the board is if they don't make a profit. So if they are operating in the red and that they owe more money for a year than they do for the than they made money, the board and the chief executives are not responsible for that debt. So they don't have to pay that money back out of their own pockets. So if a business needs to recoup finances, they don't make enough profit to operate, they then have to sell off assets. And this also happens if the corporation goes out of business, is that the individuals who are in charge of the company, they don't have to pay that money back. The corporation has to sell off everything it owns in order to recoup that money. So that means, first and foremost, easiest thing is that what some companies will do is that they'll sell off their stock. So they'll sell off a portion of the stock options that the investors have and make that money back, and then those stocks are either not made available again, or whoever comes in and buys that up, that's an influx of cash. They might close down offices in remote locations. That's selling off an asset. They sell off a building or an office space. And in worst case scenarios, if it collapses, they sell off everything down to the last piece of furniture to try and make that money back. Now, in theory, a corporation should only be worth what it owns, what it operates with, and all that. So that if it does collapse, that's what the value of that company should be. So that's why they sell off the assets. But those investors, though, the people who actually run the company, even if they run that company into the ground, they're not liable for the debt. The corporation itself, as a non-living thing, that's the one that's responsible, and so they sell off everything. And then the last side note on that point too is if we take it all the way back to the beginning, if you're the sole proprietor of a business and that business closes and you owe money, you as an individual have to sell off your assets in order to recoup that money. You cannot just shut a business down and owe a bunch of people money. You have to make sure that they're paid back first. So if that means you got to sell your car, or of course you would start with anything business related. You sell, even the furniture from the business that you started. But if that's not enough money, you're liable for that debt. So you might end up having to sell your car, or in horrible cases, people have to sell their homes in order to pay back the debt that they have. So where the corporation is different is that when it's incorporated, the proprietor of that business, whether it's an individual or a partnership, is no longer considered liable for that. So and then the corporation should be self-sustaining. And so therefore, if it collapses, the original business owners aren't liable for any of that debt. And the very last thing we have to touch on is nonprofits. So these are businesses that operate without generating a profit. Or at least that's not their goal. So, and in the case that we give is that, actually I'll get more into that in a second. So those nonprofits, they usually run off of donations, money given to them. Or they might have long-term investments set up that slowly trickle in money for them so that they can stay open. But they're, in a short sense, they're expected to operate in debt. So that's why if you register your business as a nonprofit, and typically you have to do like kind of charitable work or community service work, that's generally what a nonprofit would do. It's like that's why you're expected, it's not bad if you're operating in debt. And then, but in order to do so, those companies have to cut costs wherever they can. So to give you an example of this, the school that you're at, St. Mary's is a nonprofit. So St. Mary's operates off of tuition, and operates off of tuition. So if, for instance, we can only hire staff based on how many students attend this school. The idea with St. Mary's is that at the end of the day, it's not like there's no specific owner, and they don't go home and count piles of cash and then figure out how to disperse everything. We operate on a budget. So we have to predict how much money we're going to get in at the beginning of the year, and then we can hire accordingly for staff. But obviously we're limited based on the number of students. The more students we have, the more money we have to operate with. But at the end of the day, this school is not in existence to actually make a profit. Every year, if this school does its job, every year we break even. And that everything, for the amount of money that we take in, goes out to pay staff, facilities, maintenance, all that. That's how nonprofits work. And that's where we're going to leave off.